go to $500 silver. I mean, it just kind of ludicrous. Like I said, I don't even try to do it. At 2%, you're at 160, and then 3%, you're at 240. I don't even price silver miners at $300 silver. The next one will probably be brutal too. History tends to rhyme. We could just keep ripping higher. 10,000, 12,000, 15,000. And I'm leaving a lot on the table. I don't know. What I'm confident in is a trend to somewhere between 7 and 8,000. So that's kind of where I plan to sell. 35, 50 billion. But they've been doing QE this whole year. They've been buying bonds. Their balance sheet has been expanding. This is kind of something that hasn't really been talked about that much. And the reason why is because the Treasury is borrowing so much money. It's about $10 trillion over a 12-month period because they have to roll over about $8 trillion because Janet Yellen was buying everything on the short end. So that means that's inflationary pressure is over $1 trillion. It's a big number. We only have $5 trillion in receipts.
Gold is around $4,600 and silver is near $70. But Don Durrett believes the biggest move may still be ahead. He sees a potential path toward $7, $000, $8, $000 gold, and $200 to $300 silver. But his biggest warning isn't about the upside. It's about knowing when to get out. With U.S. debt above $40 trillion, persistent inflation, and growing pressure on the bond market, could the next financial crisis be much worse than a normal recession? Let's break down Durrett's warning.
Number one priority, by far, without a doubt, 95%, is...
Okay, so Don, you mentioned earlier that you're expecting us to have 3 leg ups in gold and silver. And so you said you believe that we're currently in the second leg. Where do you see this leg going? Do you have a price target?
I do. So this one started here at 4,000, and I think it's going to go to 60 around ballpark 6,500. So the first one went up around $2,500. Actually, it went around 3,500. Excuse me, 2,000 to 55. This one I think will go up around 2,500, and then but it could go a little higher than that. Maybe a little lower, and then it'll correct. But the last correction we just got through lasted about 7 months. The next one, I don't even think it'll last 2 months. I think we'll probably have a couple short ones, like 1 month corrections, nothing deep. I think the deep one we just had. So somewhere around 6,500 sometime next year, and then we'll correct, and then we'll go for leg 3. And then leg 3, I think will go to 28, and I think we'll correct back to probably around 5,500 is my expectation. And then we'll run to around 8,000. So those are my 3 legs, 27, 28. And maybe we'll get lucky to have a 4th leg and 29 and go to 10,000. That would be nice, or 9,000. I'm hoping for a 4th leg, but I think 3 legs are definitely in store.
Okay, so if gold peaks at 8,000, 9,000, whatever the number is, do you have a target for like what it will correct down to? So like if we look at 2011, gold peaked out at 1,900, came back down to 1,100, 1,000 or 1,100.
Right.
And it slowly creeped up after that, but it took, a significant amount of years, 9 years or so, to get back to,
Yeah, so this is the reason why I plan to sell all my miners on the way up, because I don't know the answer to that question. Are we going to correct all the way back down to 5,000 and get stuck there? Or 6,000 and get stuck there and have a 5-year correction? That's possible. Or we could just keep ripping higher, 10,000, 12,000, 15,000. And then I'm leaving a lot on the table. I don't know. What I'm confident in is a trend to somewhere between 7 and 8,000. So that's kind of where I plan to sell. I plan to sell between 7 and 8. I plan to have everything sold by 8, and then maybe I left early. But I got in early, so I can leave early. But I don't know the answer to that. I don't think anybody does. So, the question is, when does this bull market end? And when it ends, how harsh will that ending be? Historically, they've been very harsh. In 1980 was absolutely brutal, right? We went all the way to 850 gold. It crashed all the way to like 150, and then it went down, and then it basically stayed around 200, 250 for like 20 years. That was absolutely brutal from 1981 to 2000. And then the last one was brutal as well. That one was like almost 20 years long. Then this one, it was a 2012 all the way to 2024. So it was like 12 years. That was a long correction. I think that, there's different time frames you can use for when this bull market started. But I think when it took off in January of 24, it was at 2050. I think that was probably, kind of a beginning of this bull market. But you could go lower. You could go all the way down to 1500 in January of 2020. So from January in 2020 until January 2024, not much happened. But you could say that the breakout from 1500 to 2000 was kind of the breakout. I like to use January of 2020 as the beginning. So I think we're going to go till 28 or 29, like a 9-year, 10-year bull market. But you could make an argument it started a little later, it's going to last longer. But the last correction, 2011, we went from 1900 and we crashed very, very hard. 2015, 2016, I think it was 1500. Might have gone lower than that, but somewhere in there. But it was pretty harsh. From 2020, early 12, all the way to 2016, we pretty much just went down, 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 down for 5 years. Mm-hmm. So if you had a portfolio in stocks, it was pretty brutal. And then it stayed there until 2024. We had a little bit of a bounce in 2016, but nothing special. And so this one was brutal. So the next one will probably be brutal too. History tends to rhyme. So I plan to exit. I'm planning to exit around 8,000.
You had it for the exit, Don, when we get to those prices, huh? Yeah. Okay, so what are you thinking about with silver? Do you have some price targets on that? I mean, if gold goes to 8,000-9,000, I'm sure silver, it's more
absolutely
than triple, right?
So, I like to use Michael Oliver likes to use percentages because the math is so much easier. So if you use right now we're at 4,600. So if you use 1% of that, you get $46, which I think there's no. I think 1% is just way too conservative. But we were there at one time. But if you use 2%, you get 92. And if you use 3%, you're right. It's about 120. But if you use 5,000, you can use that. But I think we're going to be 1% is way too conservative, and 2% I think is a fairly good number. But we could go all the way to 3%. So if you go to, let's say we use $8,000. So at 2% you're at 160, and then 3% you're at 240. So I go between 2 and 3, which is about 200. So I think 150 to 175 is very conservative, and then I think it's going to go higher than that. And so I think a good target for silver is 200 to 300 for the top of this market. Michael Oliver thinks we're going 300 to 500. And to me, I think that's possible. But if we get at those levels, the miners are just going to go absolutely bonkers. Even at 200, they're going to go bonkers. But
Durrett expects gold's bull market to develop in several major legs, with a possible move toward $6, 500, followed by another run toward $7, 000, $8, 000. He doesn't claim to know the exact top. In fact, he says gold could eventually go far beyond $8,000. That's why his strategy is to start exiting mining positions around the $7,000 to $8,000 range. His reason is history. Previous gold bull markets ended with brutal, multi-year corrections. His silver outlook is even more aggressive. If gold reaches $8,000, Durrett believes silver could reach $150, $175 conservatively, with $200, $300 possible in a powerful final phase. That could create extraordinary margins for silver miners, but also enormous risk if the cycle reverses. Meanwhile, the broader market is dealing with massive U.S. debt, elevated inflation, Treasury refinancing needs, and uncertainty over Federal Reserve policy. Gold's recent strength shows investors are already paying close attention to these pressures. Durrett's core message is simple. Don't just focus on how high gold and silver can go. Know when the bull market is becoming a trap. Asterisk, asterisk.
Mm-hmm.
I don't even price silver miners at $300 silver. I mean, it's just the free cash flow is absolutely crazy. I mean, you're talking about $200 margins.
Yeah.
I mean, a year ago we didn't even have $10 margins, and you're talking about 200 plus margins. I mean, these are numbers that are astronomical. So I mean, it's possible we could get to 3, and I mean, Oliver thinks 5. I mean, if we get to 3 to 5, I mean, the margins at 500 are just laughable. $400 an ounce. I mean, like I said, I don't even attempt to value a miner at that level. I mean, you're talking about, 50 baggers on some of these stocks if you go to $500 silver. I mean, it's just kind of ludicrous. Like I said, I don't even try to do it because the numbers get so wonky. So I think 200 to 300 is a good target. I think, and 150 to 175 is very conservative. The Fed has been buying bonds since January. And I forget the exact number, but I think it's 35, 50 billion. But they've been doing QE this whole year. They've been buying bonds. Their balance sheet has been expanding. This is kind of something that hasn't really been talked about that much. The reason why is because the Treasury is borrowing so much money. It's about $10 trillion over a 12-month period because they have to roll over about $8 trillion because Janet Yellen was buying everything on the short end. And so is Bessent. So everything has to be rolled over. And they just keep rolling it over. And so when they roll it over, they have to borrow more money. And so that's the reason why. And that's not going to stop. And that's kind of your doom loop because over time, they have to keep printing more and more money because they have to basically fill the void. They can't allow those auctions to fail, so the Treasury has to step in. The Treasury doesn't want to buy bonds, so why are they buying them? They're buying them because they basically need to help, and so they're helping out. They're helping the Treasury out, and I think it's going to progressively get worse over time. You said who are the buyers? Well, foreigners don't want to buy anything a 10-year duration or longer. You're not getting a lot of foreigners that are showing up for that. Foreigners are showing up currently on the short end, 3-month to 2-year. We're seeing foreigners show up there, but not as much in the past, but they're still there. But the 5-year, 10-year, and 20 and 30, much less, and I don't think that's going to improve. And now, I mean, if you look at the 20 and 30 year, over the last 4 years, it's been pretty brutal because interest rates have went up, and when you're in bonds, if interest rates go up, the value of your bonds go down. I don't think it's going to improve. The bond market is becoming fragile, becoming troublesome. I don't think it's going to get much better, and I think inflation is going to pick up. I mean, if we look what's happening right now in the Strait of Hormuz and the war in Iran, not a lot of ships are coming through, so that means that's inflationary pressure. We have diesel prices that are way up. I read where the crack spread is at an all-time high. Now, the crack spread, it's a crazy word, but it's actually the margin between how much they pay for oil per barrel and then how much they sell the diesel per barrel. So they're making $100 per barrel in profit, which is an all-time high in diesel. And so that pushes the price of diesel higher. Basically, it costs a lot more to convert oil into diesel. And so energy prices are going to go up. I talked to someone today, and he said that an analyst said because of transportation cost, you can expect everything to go up about 8% in the near term, because that's about how much the energy costs have went up, and they're just going to pass it on to you. So we are going to see inflationary pressures that pushes upward pressure on the bond market. Again, for me, it's just a kind of a slow motion wreck, and because once the debt gets to a certain point, we just hit 40 trillion this week, by the way. But the key here is the interest payments. So the interest payments is over $1 trillion. It's a big number. So we only have $5 trillion in receipts. 5 trillion in receipts. That's how much the government generates in tax receipts. And we're putting out $1 trillion in interest. That's 20%. That's basically untenable. And they can't get it down, because the only way you can get it down is if interest rates go lower, and interest rates are stubbornly high because of inflation.
Wow. Yeah. Yeah, I see what you're saying with this doom loop. The interest payments to the bond yields to the inflation, and then if the Fed wants to try to use the tools of like hiking interest rates, that creates another or compounds the issue even further of interest, and then I can see like problems between the federal government and the Federal Reserve and such. And so, yeah, it's definitely a doom loop, and it doesn't seem like this is going to end well.
Yeah, and the other kind of ugly situation here is the Fed historically has always been able to be proactive. The Fed historically has been able to do whatever they want to fix a problem. I mean, go back to Volcker in late 70s, early 80s. You know, he took the federal funds rate, I think, to 16 or 18. He could do that back then, but today, could you imagine? So the tools don't exist. And then he could basically take interest rates wherever he wanted. You know, 0, 16, 18, whatever you want, basically whatever he wanted to do. And then you could print whatever you wanted as well. You know, we printed $4 to $8 trillion in 2020. You know, and we did that. Whatever you need, you could do. That's not the case today. So the Fed doesn't have the ability to be proactive, and their hands are somewhat tied. For instance, they only have really two choices here. The first choice is to fight inflation, but they can't do that. You know, Warsh came out and he said he was going to be his number one priority was fighting inflation. I laughed. I mean, I was telling people there's no chance they're going to raise rates in July. Their number one priority is not to fight inflation, not even close. I mean, it's not even. I mean, literally, it's like a little sideshow as far as they're concerned. Inflation. Number one priority by far, without a doubt, 95%, is economic growth. You got to have positive economic growth. If you have inflation, fine. 3%, 4%, 5%, that's okay. You have to have economic growth. That's job number one. The irony of ironies is that's not part of their mandate. Their mandate is supposed to be inflation and full employment. Full employment's an afterthought. They don't care if you have 3, 4, 5% unemployment, 3, 4, 5 inflation. They can live with that. So in other words, those aren't their mandates. Full employment or no inflation. Neither of those are their mandates. Those are goals. Those are objectives. They're not mandates. Mandate is that this is what we're going to do. Come in the room. Okay, how do we solve this problem, right? That's a mandate. Their mandate, it's all shifted.
So, do you believe Durrett is right? Can gold really reach $8,000 and silver $200 to $300? Or will the bull market reverse before then? Tell us your prediction in the comments. And if you want more analysis on gold, silver, inflation, U.S. debt, the Fed, and global geopolitics, subscribe to the channel and turn on notifications. The next big financial move could be closer than you think.